The question is when it comes to asset allocation now, because we mentioned at the top, we have a massive sell-off in equities the first half of the year, and also a massive blowout in bond yields, which to your point, rarely happens together at the same time. Where does that leave us?
When I think about asset allocation and through the process that I use, I look at growth and inflation, and I kind of define the world as four different regimes, right? When growth is either rising or falling, and when inflation is either rising or falling. And so the best time to be an investor in equity markets is when growth is rising and inflation is falling. That's kind of like early stage recovery, et cetera. And that's the when you get the best returns in the equity market. The second best are when growth and inflation are both moving higher. That's the second best, but that's actually commodities are the best asset class to be in at that point. Then you kind of move through the cycle and you're at the point where inflation has moved enough higher that growth starts to slow down, but inflation's still rising. And that's what we've been in the last, at least, maybe not now, but certainly been in for the better part of 2021 and in early 2022. And that's one where equities start to struggle because growth is falling and growth drives earnings. And so that starts to get people worried about equities, but commodities still do well. And that's frankly exactly what we've seen. And then the final phase is when both growth and inflation are falling, which it looks like we could be going into here. At least that's what my forecast would be. And that's traditionally when very defensive sectors do well. That's when very defensive country indexes like the US or the UK or Switzerland also do well. And that's one where commodities really start to struggle. So I think when I look at it and that's one where bonds have historically been the best place to be. Now, I think in some ways the market is pricing in the expectation of that. The only place we don't see, when we look at the traditional empirical results, the only place we don't see them pricing in that phase would be in the bond market. And so, to me, if I look at the opportunity, I might suggest that maybe the bond market in that phase looks like it's the best place to look. But I also can appreciate where, like I said, you've got some macro investor positioning long bonds, but you're also got the central banks trying to unwind that. So that's something that we have to kind of keep our eye on.